Welcome. There's an old saying that turnover is vanity, profit is sanity, but cash is king. And for a small business, that's not a cliche, it's survival. A company can look perfectly profitable on paper and still fail, simply because it runs out of cash at the wrong moment. In this video, I'll show you how to build a simple cash flow forecast, the single best tool for seeing your cash position before it happens, rather than after. I'm from the advisory team at Quantum House Australia, accountants and tax advisors. Here's what we'll cover in this video. We'll start with why cash flow matters so much and what a forecast actually is and isn't. Then we'll build one together, step by step, defining your period and format, forecasting your inflows, forecasting your outflows, building in scenarios, and reviewing your actuals. We'll look at a short real-world example, the common pitfalls to avoid, a quick start checklist you can use this week, the key takeaways, and how we can help. Let's start with why this matters so much. Cash is the oxygen of a small business. And here's the uncomfortable truth that catches good businesses out. Profit and cash are not the same thing. You can be profitable on paper, your sales comfortably exceed your costs, and still fail, simply because the money isn't in the account on the day a big bill falls due. Yet most SME owners in Australia manage their cash reactively. They check the bank balance when a bill arrives, rather than forecasting what that balance will be in 4, 8, or 12 weeks' time. A simple cash flow forecast changes that completely. It shifts you from reacting to whatever lands in the account to seeing what's coming and acting in advance. So what exactly is a cash flow forecast? It's a forward-looking projection of the cash coming into and going out of your business over a defined period, typically anywhere from 13 weeks to 12 months. Now here's the crucial distinction. It is not the same as your profit and loss statement. Your P&L is accrual-based. It records income when you earn it and expenses when you incur them, regardless of when the money actually moves. A cash flow forecast tracks the real thing, when invoices will actually be paid, when supplier bills are actually due, when tax obligations actually fall. Think of it this way. Profit tells you whether your business model works. Cash flow tells you whether you can pay the bills next month. And it lets you see a shortfall coming before it arrives, so you can act calmly rather than in crisis. Let's build one, step by step. Step 1. Define your period and format. For most SMEs, a 13-week, that's a quarterly, rolling forecast is the most practical place to start. 13 weeks is short enough that your estimates stay reasonably accurate, but long enough to give you meaningful warning time to actually do something about a problem. The format can be simple, a spreadsheet with weeks or months as your columns, and a row for each category of cash inflow and outflow. You don't need fancy software to begin. Your accounting system, Xero for example, can export historical data to help you populate it quickly. And the single most important habit, review and update it weekly or fortnightly. A forecast you build once and forget is worse than useless. Step 2. Forecast your cash inflows. These include your customer receipts, any government grants, R&D tax incentive refunds, loan drawdowns, and proceeds from selling assets. But for almost every business, the big one is customer receipts. And that's exactly where owners tend to go wrong, by being too optimistic. Here's how to do it properly. Start by mapping your outstanding debtors by their due date, who owes you, and when it's genuinely due. Then apply a realistic collection assumption based on your actual debtor days, not your best hopes. If your customers really take 50 days to pay, forecast 50, not 30. Then layer in the new sales you expect to invoice and collect within the period. And throughout, the golden rule is to be conservative. Optimistic assumptions are the enemy of a useful forecast because they hide the very problems you're trying to surface. Step 3. Forecast your cash outflows. These include wages and superannuation, supplier payments, rent, loan repayments, your ATO obligations, GST, PAYG, income tax installments, and any capital expenditure. The single most important discipline here is timing. Let me give you an example. A $50,000 tax bill due on the 28th of February has a completely different impact depending on whether you identified it back in December and planned for it, or stumbled across it in late January, with 2 weeks to find the money. So list every known obligation by its expected due date, the day the cash actually has to leave, not just the month it accrues in your accounts. Tax and super in particular tend to land in big lumps, and those lumps are exactly what catch businesses out. Step 4. Build in scenarios. A single scenario forecast only gives you one version of the future, and the future rarely cooperates. A well-structured forecast includes 3. A base case, your realistic most likely path. A downside case, what happens if a major customer pays 30 days late or a key contract is delayed? And an upside case, what if you win that new project you're currently tendering for? Modeling these lets you stress test your cash position to see just how much it would take to cause a real problem. And critically, it reveals the thresholds at which you'd need to act, the point where you'd draw on a credit facility, delay some capital expenditure, or push hard on collecting your debtors. You work that out calmly now, not in a panic later. Step 5, and it's the one that separates forecasts that work from forecasts that don't. Review your actuals against your forecast. The most common reason cash flow forecasts fail isn't bad maths, it's that they get built once and then never updated. The forecast has to be a living document. So every week or fortnight, compare what actually happened to what you forecast. Where there's a variance, understand why. Did a customer pay late? Did a cost come in higher than expected? Then roll the forecast forward another week. This habit does 2 things. It steadily improves your forecasting accuracy, and over time, it deepens your instinct for how cash really moves through your business. And that instinct is worth a great deal. Let me bring this to life with a short hypothetical example. Picture Brightwork Joinery, a fictional cabinet-making business. Sales were growing, the profit and loss statement looked healthy, and so the owner managed cash the way many do, by glancing at the bank balance whenever a bill landed. Then they built a simple 13-week rolling forecast, and it flagged a problem 6 weeks out. In a single fortnight, a $48,000 BAS payment and the quarterly superannuation guarantee both fell due, in the very same period that a major customer's large invoice wasn't yet scheduled to be collected, while payroll still had to run as normal. On paper, the business was comfortably profitable. In cash terms, it was heading for a $30,000 shortfall. But here's the point. Because they could see it 6 weeks ahead, rather than the week it struck, they had options. They brought forward collection on 2 overdue invoices, deferred a non-urgent equipment purchase by a month, and arranged a small overdraft facility as a backup buffer, just in case. In the end, the shortfall never eventuated. Payroll and the ATO were paid on time, and the equipment was bought the following month out of ordinary cash flow. Nothing about the business was unhealthy. It simply needed to see around the corner. Illustrative only, of course, but that's exactly what a forecast gives you. Time. Step back for a moment and look at what really changed there. Brightwork's numbers didn't change at all. The same bills were due, the same invoice was outstanding. What changed was when they saw it, and that's the whole game. Managing cash reactively means checking the balance when a bill lands, getting surprised, scrambling, and making decisions under pressure, often the expensive ones. Being in control means seeing weeks ahead, spotting shortfalls early, and making calm, deliberate choices. It even changes the conversations you have with your bank. You're asking for a facility from a position of foresight, not desperation. A forecast doesn't change your numbers. It changes when you see them, and that changes everything. Let me flag the most common pitfalls, because they're predictable. The first and biggest is building the forecast once and never updating it. That turns a living tool into a stale guess. The second is optimistic assumptions, especially on collections. Best case thinking hides the very risks you need to see. The third is forecasting on an accrual basis instead of a cash basis. Modeling the month a cost appears in your accounts rather than the day the cash actually leaves your bank. And the fourth is ignoring the ATO's due dates. BAS, PAYG and Super arrive in lumps, and if you don't map them to their real due dates, they'll ambush you. Every one of these is easy to avoid once you know to watch for it. If you want to get started this week, here's a simple checklist. 1. Set up a 13-week rolling spreadsheet with weeks as your columns. 2. Export your recent history from Xero or whatever system you use to give yourself a head start. 3. Map your debtors and your known bills by their due dates. 4. Add your ATO obligations, GST, PAYG, and Super, at the dates they actually fall. 5. Build out your base, downside, and upside cases. And 6, the one that matters most, commit to updating it every week or fortnight. Do those 6 things and you'll have a genuinely useful forecast, not a one-off spreadsheet that gathers dust. So, to pull it together, profit and cash are not the same thing. That's the idea to hold on to. A 13-week rolling forecast is the practical place to start. Forecast by due date, because timing is everything. Be conservative on your collections and model more than one scenario. Review your actuals against the forecast and roll it forward. And remember the real prize. A forecast lets you act early, on your own terms, rather than in a crisis. That single shift, from reactive to in control, is what protects a healthy business from an avoidable cash crunch. This is where Quantum House Australia comes in. Building a genuinely robust cash flow model takes accounting expertise, real knowledge of your industry, and familiarity with the right forecasting tools. Our outsourced CFO and business advisory team build and maintain cash flow forecasts for SMEs, integrating your accounting data with industry benchmarks to produce forecasts that are accurate, actionable, and presented in formats suitable for both internal management and external stakeholders, like your bank or your board. And if cash pressure is coming from a tax debt, which is far more common than people admit, our colleagues at Australian tax experts, tax advisors and lawyers can handle ATO payment arrangements and disputes, working right alongside the accounting. One team, both disciplines. So here's the thought to leave you with. Stop managing your cash by the bank balance. The businesses that sleep well at night aren't the ones with the most cash. They're the ones who can see what's coming. Quantum House Australia builds and maintains cash flow forecasts for SMEs, accurate, actionable, and ready for whoever needs to see them. Visit quantumhouse.com.au or call our Sydney office on 1300 809 697 and we'll set yours up. Thanks for watching. Quantum House Australia, accountants and tax advisors, setting a new standard.